This podcast is brought to you by Pragmatic Play, a leading game developer providing player favorites to the most successful brands across the industry. With an award-winning multi-product portfolio of slots, live casino, bingo, virtual sports, and more, Pragmatic Play is powering up new possibilities of play through one single API. Visit pragmaticplay.com and discover your favorite every time.
Welcome back to the second episode of Vested Interest. Lloyd, Benjie, it's great to have you guys with us here today. I am currently hiding in a cabin in the middle of nowhere here in Sweden. But how are you doing today, Lloyd, first of all?
I'm doing great, Pierre. Thank you. And I will say the respite from the vigors of everyday life that you are finding for yourself, I think, is quite well deserved after that fantastic conference Benjie and I joined you for in Valletta a couple of weeks ago now. I thought it was an absolute success and one of the better European conferences that I can remember attending recently. So hats off to you guys, and congrats on the well-deserved time spent hiding in the forest in southern Sweden.
Yeah, thank you for that, Lloyd. And I'll tell you, though, that you missed out on the closing party of showers. Me and Benjie were having quite a good time there. And I think Benjie had a good inauguration of the showers, our 10-year anniversary of the pool party. But yeah, Benjie, how was your trip to Malta? How was everything over there?
Yeah, no, look, echoing what Lloyd says, it was a fantastic event. My first time in Malta, surprisingly, just given how long I've been in the space, but my first time visiting Malta. And the venue was spectacular. The content was terrific. And it was some different faces for me, not just different from the US events, which I expected, but different from some of the other European events that I've attended. And I think it was just, the entire thing was really well orchestrated. And yes, to your point, the closing party, which wasn't technically part of the conference, was certainly a good time. So I'll leave it at that for
exactly.
now.
What stays at showers, what happens at showers stays at showers. Let's leave it at that. And also,
after that event, Benjie told me that it's something that you have to do once in your life. But if you care about your life expectancy, you might not want to do it twice or any additional times, which of course, was meant only in the most complimentary and fun-loving fashion.
It takes a good year out of your life, I think, this
exactly.
thing. But yeah, totally worth it. So guys, first of all, I would love to talk a little bit about a really interesting topic. I mean, obviously, on the European side, stake.com has seen like the rise and rise in the last couple of years, and obviously from a North American context, stake.com is known as an operator that has been operating in the let's say outside of the regulation in regulated markets. Stake is obviously very controversial for many different reasons. Their highest profile ambassador, Drake, is obviously one of the guys that have really kind of built this brand and brand presence in North America. And they have now kind of alluded to, or Ed Craven, the CEO and the founder, has alluded to that they have a really big US acquisition that they are currently working on at the moment. So this obviously begs the question, who could that be? And I would really like to talk about this a little bit today and hear kind of you guys' opinion as well from a North American context of what your opinion is on stake in general and what you think is going to happen here. I mean, first and foremost, obviously they have been operating it's a known secret, let's say, that they have been operated outside the regulation. And also interesting kind of from due diligence perspective and being able to be approved by regulators locally in the US, what all of this means. But first of all, Lloyd, I don't know if you read this story and what do you make of it? Like who could a potential target be for a stake to acquire?
Yeah, definitely raised eyebrows. I think it was EGR that first broke that story a week or so ago. And moving aside the regulatory piece of it, because that is really complicated and certainly a big question mark here. But from purely a commercial perspective, it of course makes sense that Stake would be interested in the U.S. market, given its size, if they can solve for the regulatory piece. And I'd say that, look, I don't have any specific inside information here whatsoever, but there are really two primary targets in different categories that are at the forefront of the rumor mill right now. One, I think, much more so than others. The slightly less popular target stems from the fact that allegedly earlier in the year, Stake was kicking the tires on some B2B companies that would provide them with the ability to operate a game of skill DFS style product in the US. And the fact that those conversations happened, I think, has led to potential rumors that maybe they would acquire a DFS or DFS plus company, whatever you want to call it. And it would seem to me that the only three that would be large enough to warrant the type of commentary that we're seeing would be Prize Picks, Underdog, and Sleeper. And we'll get Benjie's thoughts on this in a moment. I have a really, really hard time seeing Adam at Prize Picks or Jeremy at Underdog selling right now. And so if it were a DFS target, Sleeper feels like, potentially the highest probability. But I'd say the target and the strategy at the forefront of the rumor mill is supposing that Stake will try to buy an operator that has online casino and online sportsbook technology as well as market access. And from a size and traction and market access perspective, Rush Street Interactive seems to be the most logical target. And again, the one that is what everyone seems to be whispering among people who whisper about these things. So I have no idea. I don't know if any such acquisition will take place. It is beyond my expertise to understand exactly how the regulatory and licensing process would work, but something in the fantasy space like Sleeper, or perhaps more likely something in the real money space like Rush Street Interactive, seem to be eligible and plausible targets for Stake to enter the US through.
Right, Benjie, what's your thoughts here?
So, yeah, look, I mean, my commentary on the fantasy piece, and I have heard those rumors as well. I agree with you that Underdog, I think, is pretty much a non-starter in the sense that they're kind of getting going in their journey as it pertains to the migration to the sportsbook piece, and they're still in early days as it pertains to that process. I'd be pretty surprised if they were a viable target. I'd be less shocked if it were Prize Picks as a target on the fantasy side. Again, I don't think it's fantasy altogether. I think it's online sportsbook, and the rumor mill is exactly that it would be Rush Street that would be the ones most likely to be embarking in these types of conversations. It could have been PointsBet until more recently, but they're now off the table. So echoing what you would say as it pertains to the sportsbook piece, on the fantasy side, if in fact that were route they were going down, Sleeper would be the most likely. But look, you look at where Prize Picks is at. Obviously, they're having massive success right now, but at some point they want to achieve an exit type ROI for their investors and for their stakeholders and shareholders. And with some of the headwinds in fantasy right now in the US, one could surmise that it might not be so easy to achieve as such. And obviously, they're taking a lot of steps right now at Prize Picks to bring on board some people that can help with lobbying efforts as they gear up for that piece of the battle in terms of trying to defend their turf as it pertains to what they do as a company. But I would be less surprised if it was them than you would be.
That's interesting that the rumor mill is saying RSI, because from a layman point of view, just looking at face value here, I would assume that Penn would be a more likely acquisition target due to the Barstool brand, which seems to be very on brand for Stake, let's say, with a very controversial CEO there and Dave Portnoy, and a brand that is very focused on content production and kind of speaking to a different marketing themselves in a very different way than the traditional sportsbook, let's say, which is very kind of on brand for Stake. Why wouldn't Penn be the obvious choice here, Lloyd?
First of all, that's most likely just going to be an even bigger acquisition to swallow than an RSI. I think your points are well taken. Certainly, it seems like the combination of the Stake.com name and Dave Portnoy present a seriously challenging, regulatory and licensing process. My only other real comment would be that the only way that would make sense is if they specifically, in my view, spun off and acquired Penn Interactive Ventures, which is where the digital and online operation exists. I have a really hard time imagining Stake acquiring Penn's retail brick and mortar business that is so far divorced from their core competency, let alone the size of the business that I think they could ingest. But yeah, I suppose, spinning off the digital business and Stake acquiring that is not out of the realm of possibility. I think Penn is just finishing their migration over to all the scores technology and finishing some of their, licensing and regulation tasks on their own. And so it feels a little like maybe not the perfect time for where they are on their journey. But I do recognize some of those thematic crossovers or synergies between the sort of streamer, influencer, mobile focus of getting people to play.
Right. And, yeah, Benjie.
Yeah, I guess my comment there is that look, it's certainly possible that Penn could be a target accordingly, but you look in terms of the points bet situation, and they were in a position where they more or less had to do something because of their cash position. RSI isn't in the exact same court, but they're not in as strong a cash position as Penn would be. So it would just be an easier mountain to climb to try and get something done with an RSI than it would be with a Penn.
Right. Makes sense. Are there other operators that could be in the crosshairs here for a stake? Or other kind of like say like outside of the big four that could be a potential target for a stake? Because it seems like the industry is consolidating more and more. There are fewer and fewer operators with multiple licenses, so on and so forth. So it seems like there isn't really that many targets if you want to acquire a solid sportsbook today. Benjie?
I mean, potentially parks, and the only bet parks, and the only reason I say that is because there have been murmurings of bet parks being in acquisition talks over the last 6 months to a year. So we know that they're game to have conversations that make sense. I don't know if that's anywhere near as sizable as any of the other two that you just mentioned, but I can certainly see some form of M&A activity involving them, and they are a reasonable size player, obviously a tier 2 to tier 3, but there's still some size and scope there, albeit more regional.
Yeah, I would add to that same category, potentially, someone like PlayUp, who seems to be struggling to find a home, even maybe a WinBet, which has been a relative underperformer. None of these companies bring the amount of vertical integration and market access that an RSI would bring. It feels like if your goal is to maximize state licenses and proprietary technology that you own and use to operate your sportsbook and casino per dollar spent, that RSI would be the obvious choice. And I think that's part of why they are at the forefront. I don't know how many states Bet Parks has market access in exactly, but I know it is far fewer, certainly, than someone like Rush Street.
Just to throw in a curveball here as well. I mean, one household online sports betting and online gambling operator here in Europe is Kindred, which is one of the major operators here, and they also hold licenses in North America. I think they have something like 4 or 5 licenses, something like that, in the states where they can operate online gambling. They have also communicated they are going through a strategic review currently. It's a publicly traded company, Swedish roots, and they're also looking to sell at the moment. And as a bit of a curveball, it could be as well interesting to think about Kindred as an acquisition target as well for stake, because not only is that kind of a way into the regulated environment in North America, but it's also a way into the regulated environment in Europe as well. Kindred their pride has been essentially that they are looking to derive as much revenue as possible from regulated markets rather than kind of pre-regulated or gray markets in Europe and elsewhere. And that also makes it an interesting discussion point here, because this as a lead up to this, to put stake into context how big they are, Financial Times recently reported that Stake is the 7th largest gambling firm in the world based on revenue, not EBITDA, but revenue, which puts them bigger than DraftKings, for example, just in revenue. And then imagine the margins that they are currently enjoying outside of the regulation. It puts them in an insanely strong financial position. Rumors are that they are generating something like $2 billion GGR, $2 to $3 billion GGR a year, and you would imagine that they would enjoy something like 30 to 50% margins on that revenue, perhaps, which would then lead to an EBITDA of $1 billion plus a year. So obviously, an extremely financially strong company that is potentially now then looking to kind of flip the switch into the regulated environment, because it is a very interesting move here. Like, if they would acquire a North American sportsbook, you would assume that the regulators would not allow them to offer crypto solutions, even if it's by a subsidiary, for example, or something like that. You would assume that the due diligence is very straightforward in that regard, that they won't be able to do that. So they would need to flip the switch completely in the US and go fully regulated. It's very interesting, actually. I don't know, Lloyd, if you have any further thoughts here on stake in general and this kind of strategic shift. Perhaps they are recognizing that they can't operate outside of the regulation forever, with the history of Black Friday and the 2000s and so on.
Yeah, I think I might have lost you for a minute there, but I'm pretty sure I heard the question. I don't have too many extended thoughts, and I want to make sure we leave time. I know you have other topics to get to. Could Kindred make sense? Sure. I feel like when you say you are going to make a major acquisition to enter the U.S. market, Kindred doesn't really come to mind as being coherent to that particular language, but it doesn't mean it's not possible. I think unquestionably Stake will not allow any crypto MetaMask deposits from U.S. customers if and when they operationalize here. The question is, will U.S. regulators give Stake a license in the U.S. if they are still operating and allowing a crypto on-ramp for payments in other jurisdictions and generally carrying on and call it a semi or super regulated manner outside of the U.S. But you're right. It'll be interesting to see. They're a 300-pound gorilla in the room. They reportedly did $2.6 billion in GGR last year compared to $2.2 billion for DraftKings. And they are a formidable player if they decide and find a plausible way to start addressing consumers in the U.S. market.
And a closing thought, or rather on my end, look, as it pertains to this topic is, when you talk about the U.S. regulators and what would they or wouldn't they allow, there's precedent in the past for gray market operators coming into the U.S. Or gray market companies getting involved in the U.S. space and other international spaces, but generally they took the approach of trying to clean things up before coming in. Even look at Entain, which, before they got involved and did their deal with MGM, they had to clean up some of the things that they were doing in certain parts of the world in order to make that transaction happen. Whereas if Stake were to go out and make an acquisition, does that mean that they would siphon off the portion of their business that is quote unquote gray, which is virtually their entire business? So, it would be really interesting to see how that unfolds. Now, look, the U.S. regulators, some of them that you speak to will say, look, we can't really police what goes on in Southeast Asia and other parts of the world. So as long as they're not doing anything that's gray within the U.S., then we're okay with it. So it'd be really, really interesting to see, based on the precedence of how some of the other folks and companies that are of significant size and scope have gone about cleaning up their acts before coming into the U.S. versus what Stakes would do if, in fact, they pursue an acquisition.
We shall see. It certainly would be the biggest news of the year, more or less, if a big acquisition would come from Stake and what it would mean. I want to move on to the next topic here, something I'm quite curious about to just discuss with you guys. Not exactly a news story here, but just some thoughts that I want to share today. In the US, the online sports betting and the online gambling environment is consolidating. Obviously, we saw that recently now with Fanatics acquiring PointsBet, which we are going to talk a little bit more about in a little bit. Operators are struggling, whereas the kind of top four are enjoying a bigger and bigger market share. Some of the suppliers are trying to enter the space but failing. And it seems like the space is consolidating and the bigger is getting bigger. And in that context, I'm really curious to hear your thoughts as investors, what that means for you guys. Lloyd, obviously, with the Sharp Alpha investments, Sharp Alpha partners. Sorry, I'm misquoting. Sharp Alpha advisors. There we go. Third time's a charm. And Benjie, you're an active investor in the space as well, of course. What does this kind of environment mean to you guys now as funds? It must be challenging to some extent to find new opportunities in the startup landscape if the space is consolidating in general. Like, what is the VC's place in the online sports betting, online gambling world today in North America? And do you feel it's becoming more and more challenging, Lloyd, to find the right opportunities? And even from an LP perspective, is it becoming more difficult to kind of raise funds from your side that you can then invest into other companies?
A lot to cover there. Let me see if I can touch on each of the questions you've asked, and then we can dive into any of them in more detail. One important framing that I do think I often see lost, or a point of nuance that I see not integrated into conversations like these, is the fact that, yes, it is true that inflation and interest rates are a bit elevated and deal volumes in the venture space are down year over year. But if you want to talk aberrations, you want to talk about true statistical anomalies in the world of venture capital financing, 2021 was the aberration. Things right now, when you zoom out, look actually pretty normal and orderly from a historical perspective. Every single indicator that we use to measure venture capital financing activity, deal velocity, deal volume, unicorns minted per month, price to earnings, price to sales ratios, EV to EBITDA multiples, you name it, reached absolute all-time highs, unprecedented levels in 2021. And while it certainly is a tough environment now, I think it feels a bit tougher to people who are consumed by a bit of recency bias and comparing the current environment to 2021, which really was never sustainable and almost not reality, if you will, in the first place. That said, in terms of finding opportunities in the space, it definitely is a difficult time to be a mid-sized generalist fund. If you are Andreessen, Horowitz, or Sequoia, or Insight Partners, you're doing fine. If you're an ultra-specialized fund in a sector with strong secular tailwinds and who founders in the space recognize as being a premier name to have on a cap table, you're also doing fine. But if you are just a generalist investor who is sort of in the middle, sizing-wise, not quite a household name like Andreessen or Sequoia, and trying to tag along to different deals in different spaces as you found the opportunities, I think it certainly is a lot tougher. We can get back to startups and the startup fundraising ecosystem in a moment, but you asked the question about raising as a venture fund from LPs, and what I'll say is that it definitely is more difficult today to raise a fund, especially as a first-time manager, than it was 3 years ago. But quite interestingly, if you ask certain investors, hey, are you interested in a venture fund today? They might say, it's really tough for us to allocate to venture capital right now. And if you then follow up and say, well, when was it easy for you to allocate to venture capital? They will say something like, oh, well, it was easy for us in 2020 and 2021, which ironically were the worst times possibly ever to allocate to venture funds. And that maps onto this long-standing wisdom in the world of venture capital that when it is easy and enjoyable to be investing, it is a bad time to invest. And when it is more painful and uncomfortable and difficult to deploy capital, that is the best time to invest. And it brings up the classic Warren Buffett quote of being greedy when others are fearful. And I think that's sort of exactly the environment we are moving into. Yes, there is less LP capital available. Some LPs are just finding themselves inadvertently overweight to venture capital. Others see better risk-adjusted return in a 5% T-bill. But for investors that have an edge and that have proprietary deal flow and the ability to get into deals, you have a confluence of two really powerful forces right now that I think might make 2024 one of the best vintages in venture history. You have investor friendliness moving toward an all-time high. But at the same time, companies that previously were being incentivized by the market to optimize for growth and hype and salesmanship and press releases are now being incentivized to optimize for traction and execution and sustainable profit margins and unit economics. And so in theory, there should be this period we are entering where, as again, either a top tier Andreessen or Sequoia type investor or someone more specialized in a niche area, you're investing in companies at half the price that have twice the likelihood of a successful outcome. And so I think the future is quite bright for the Lloyd Danzigs and Benjie Cherniaks of the world, as well as for the Sequoias and Andreessens of the world. And I'd say within our LP base, anecdotally, we have a split. We have some who are saying, hey, we're stepping back. We're not allocating heavily to venture at this time. But we have others who made their fortunes investing after the dot-com burst, after the great financial crisis, and they're pushing all their chips on the table and saying, these are the exact environments in which we like to deploy capital behind a manager whom we trust as a steward of. that capital. So mixed bag for sure. Lots of challenges out there, but important to contextualize that I think it feels a lot more dire in relation to what we were experiencing only 18 months ago.
Fair enough. Great summary, Lloyd. And over to you, Benjie. I mean, what type of opportunities are you looking for in this environment today in online sports betting and online gambling?
I don't know if it's a question of looking for a specific type of opportunity in the sense that from an investment standpoint, I'm somewhat all over the map. But to some of Lloyd's points, I think a real critical one now is that, even a year ago, when you had all of that hype from 2002 to 2021, and then in 2022 was somewhat of a difficult year because the market had changed, but a lot of the entrepreneurs kind of had difficulty accepting that new reality. But now that we're a year removed from that, I think that virtually everyone's on the same page. If you're a startup and you're kind of getting going in your organization, now that you need to take a practical approach, that the unit economics have to be sound, that you need to be focusing on bottom line EBITDA as opposed to strictly revenue targets. And you need to be more than just shiny press releases in order to execute, and not just from a raising capital perspective, but from an M&A perspective as well. So I think that the companies that we're seeing now and the way in which the entrepreneurs are approaching it, is a little bit more synergistic with where the market is. And to Lloyd's point, I think that that's going to be sustainable into 2024, 2025 beyond, because that's just what the new reality is, what the more realistic reality probably should have been all along. So I think that puts us in a pretty good spot from an investment standpoint heading into the latter part of 2023 and beyond. And the other tailwind alongside that I think is beneficial is that, we spoke about this last time, but M&A is heating up, right? So
Yep.
You have that convergence as well. And as we see deals in our space starting to happen, that lends itself well to being able to point to those deals and, for the venture capital firms to talk to their LPs, and for those LPs to continue anteing up because they can see that for a number of companies, be it ones that they're involved with or other, that M&A is kind of coming back to the forefront, and that all of these challenging times are just cycles that we have to work our ways through as we allow the cream to continue to rise to the top rather.
And I would just add, if I could, I think there's a lot of, and in some ways, well-placed fears of what at the most extreme people sometimes refer to as an impending startup extinction event, or just perhaps, more timidly, a massive challenge for startups that may, have to fall out of the market. And what does that mean for the broader ecosystem? And I think an analogy, again, just to go back to my point about framing, sometimes I feel like people talk as if, I'll use a weather analogy here, as if we had good weather for 15 years, and then suddenly 18 months ago, it started raining all day, every day. But actually what happened is we had mixed weather, variable weather, although improving from, let's say, 2009 to 2019. And then out of nowhere, for 2 years, it was sunny and no clouds in the sky and the perfect temperature all day, every day. And now we're back to having mixed, variable weather again. And so unsurprisingly, the companies who during the sunny days were built to only sell sunglasses and suntan lotion and only sell from outdoor locations without ever having a permanent fortified storefront are going to have to very quickly adapt to the new climate where we have mixed weather and some days are rainy and some days are sunny and some days are cloudy, or they're going to have to fall out of the market, perhaps because there wasn't really a place for them anyway. And so I think that is something that we will see. Companies that were purpose-built and only really made sense in a zero interest rate environment where the cost of capital was low and other artifacts of that 2021 era, it makes sense that they would struggle to find footing and that the investors that raised money to back them would struggle to find footing in the current climate. But that does not at all take away from the inherent need for innovation and the opportunities to back great founders solving important problems in industries that are growing rapidly.
Well, at least if we turn this analogy and we translate the industry into which country we are talking about climate-wise, fortunately, the industry is not here in Sweden, which has a famous saying where summer is the best day of the year. So fortunately, we're not there yet, at least. So that's a positive side. But Lloyd, if you look forward, into 2024 and 2025. How do you think the startup landscape and opportunities will play out? I mean, I'm asking also from my own perspective here, right? As a conference organizer, we organize exhibition conferences, so we also need to look at who are the potential exhibitors, which are often, companies in their kind of younger years, let's say. If we compare the landscape in the US to Europe, for example, we have a much more limited space in the US due to the fact that there just isn't that many operators, let's say, which are obviously the customers that supports the whole ecosystem. But again, like if you look into 2024, 2025, like do you see how do you see the space developing overall when you think of the startup landscape specifically?
I don't know. There's a lot of ways I guess I could answer that. One thing I would point out is that while it is true that there is a consolidating number of B2C sportsbook and casino operators that could be potential buyers of startups, they are not the only potential buyers out there. Benjie and I were involved early on in Betcha, which was a daily fantasy company that was acquired by Vivid Seats, which is a StubHub competitor, a ticketing company that wanted to cross-pollinate its user base to and from ticketing and sports betting, not dissimilar from the sort of one-stop shop that Fanatics is trying to put together. You look at a company like Endeavor that historically had very little, if anything, to do with sports betting, but then went and bought OpenBet and IMG Arena. And even, Barstool was historically not a sports betting company, but was ultimately acquired by a casino operator. So I do think an important theme as relates to exit opportunities is the convergence of all these different consumer behaviors under the umbrella that I often refer to as competitive entertainment: sports betting, casino, lottery, ticketing, merchandise, collectibles, digital collectibles, fractional ownership, even potentially retail stock and crypto trading and things of that nature. I think that overall, the startup landscape has some incredible founders building incredible products that will allow this industry to expand the size of the total addressable market. Perhaps more importantly, will increase the profit margins and hold rates. Think about products that are driving profitability right now. Same game parlays and micro betting almost entirely have been provided by startups that were launched in the last few years and now are completely revolutionizing the income statements and the hold rates of some of these operators. We'll see a lot of technology that makes the business more sustainable and durable, whether it's the responsible gaming side, payments, KYC, AML, affordability checks, fraud prevention, things of that nature, and expansion into new geographies. Latin America is the hot area of focus right now, Brazil in particular, as well as the rest. But over a longer time horizon, I think India, potentially Japan, and even admittedly further down the line, the Middle East are areas where we will see continued real money gaming expansion, and all of that will be enabled by technology solutions, many of which are provided by startups that are in their incubation phases today.
I would agree with that point in the sense that many of these companies, when you look at the same game parlays and the micro betting, they're still in their early phases and early stages, and the expansions geographically you allude to is a very real dynamic. But pointing squarely back at the US market, I think one of the themes to look for as we go to 2024 and 2025 is the growth of iCasino. And gradually we expect to see some additional states anteing up and coming into the fray. It's taking longer than people expected, and there's a whole bunch of reasons for that we can get into on a separate podcast. But if and as we see more movement in that space, we're already seeing some interesting startups. You look at companies like Betty as an example, but there's also a number of them on the B2B side that are providers of casino related games, technology, and I think that could play a factor in the startup landscape as we look at the next few years ahead.
Speaking of acquisition and the future, moving on to the next story here, which is the Fanatics and DraftKings drama that unfolded here recently. So Fanatics obviously have been looking to launch online sports betting. This is an open, not even a secret. This has been an indication and communicated openly by Fanatics. And the industry has been waiting to see which operator they will be acquiring. And recently, Fanatics made the bid of $150 million to acquire. Now I lose the. Now listen, help me, guys. To acquire.
PointsBet US.
PointsBet. Yes, there we go.
US assets, not the whole company, but
exactly,
the US assets, right?
The US assets, $150 million, and out of nowhere, from left field, DraftKings countered that bid, seemingly with no real reason, but they countered with $195 million bid, to which then Fanatics had to up their own bid to $225 million, which is 50% higher than the original bid, in order to close the deal. Michael Rubin, the CEO of Fanatics, was quite livid over what DraftKings communicated here, and said that the only reason why DraftKings would make this bid was to kind of block the acquisition, or to make it more expensive for Fanatics. Michael Rubin explained that to kind of complete this deal, it would cost DraftKings around $500 million, which is a lot of their balance sheet, of course, there. I'm quite curious about this unfolding drama, Lloyd. Like, do you agree with Michael Rubin here that DraftKings' only reason to make the bid of PointsBet US was essentially to make it more difficult for Fanatics to enter the online space in the first place?
I do have a lot of thoughts, but I feel like I've been taking the first crack at each of the answers. So let Benjie maybe take the first crack, so I don't steal his thunder, as I probably was previously, and then I'll build on it. In the rare case that Benjie misses anything, I'll
yeah, absolutely. No, my bad. You're next to me here, Lloyd, in the window, so like I'm like passing over the ball here. But Benjie, let's jump over to you on this question.
Sure. So, first of all, Michael Rubin being infuriated by the DraftKings approach on it, and seeing that they had no reason to come in with a bid, they did have every reason to come in, which was to drive the price up for a competitor. And it seems to have worked famously, if in fact that was their reason. I kind of feel as though, Michael Rubin and the PointsBet team had an opportunity here to stand their ground. And if in fact they viewed this as a ploy in which DraftKings was strictly looking to drive the price up, which seems to have some logic to it, because really, it just makes so much more sense as an acquisition for Fanatics than it does for DraftKings. DraftKings doesn't need the technology. They don't need the operational aptitude and know-how. They don't need the human resources. These are all things that the Fanatics team, they inherit a platform, they inherit a trading team, not to mention all the market access that Fanatics is in dire need of. And of course, DraftKings already has all that market access. So on the surface, it doesn't really seem to be any reason for DraftKings to have fronted the offer, other than feeling correctly that they could drive the price up for Fanatics. I almost wish that Michael Rubin and the Fanatics guys had taken the approach of standing their ground and saying to the PointsBet guys, look, we came in with our offer. Our offer was real. Our offer was credible. The offer will get done. The deal will get done. We think this is an end run. If you guys really think that you can get a deal done with DraftKings under those terms and at that dollar amount, go at it and then come back to us if it doesn't work. I kind of wish they had taken that approach. But on the flip side to that, we all recognize that the 150 price tag was somewhat of a basement bargain price tag. There was no other bidder, it looked like. And, Fanatics didn't really have Fanatics. PointsBet USA, PointsBet didn't really have any other choice than to accept the offer because it was the only offer on the table. So the 150 was probably too low to begin with. So, it ending up at the 225 mark is probably more practical as to where it should have been all along. But I think there was an opportunity for PointsBet or for Fanatics rather, to take a different approach and put their feet in the stand. And I think it might have worked out for them if they had.
Yeah, I think that all makes sense to build on it. I agree. I don't think there's any particular stake in a business perspective to put into, Michael Rubin allegedly being livid. It has come to surface that there is some sort of interpersonal conflict potentially between Michael Rubin and Jason Robbins that goes back a couple of years. And I heard a really funny off the record example of some fallout there that I don't think I can share while we're recording here, but maybe in the post-production room I'll mention later on. I think my starting point for thinking about this deal is what Benjie sort of ended with, which is that it was quite well known that PointsBet US specifically, was in a very dire position. They would have had to raise a ton of capital from investors by issuing new shares that would have diluted everyone if they did not get a deal done here. And so the 150 price almost certainly was an artifact of the lack of negotiating leverage that PointsBet had at the time. I agree with Benjie's points that it seems that Fanatics would derive far more value from a PointsBet acquisition than a DraftKings would. However, just to play devil's advocate, Entain is reportedly buying Angstrom for $200 million. DraftKings acquiring PointsBet, getting Bannock, and blocking a competitor for $5 million less seems like, maybe on a relative basis, not such an unjustifiable price. And to that point, I would add, defensive deal making and blocking competitors has been, one of the most common tools in the M&A toolkit for quite a while. So it's not that it would be unprecedented. Some people argued that DraftKings' offer for Entain for $22 billion a couple of years ago was somewhat defensive and intended to stymie MGM specifically. And I think DraftKings has a bit of a history of defensive deal making, and certainly many other companies do as well. I think the 225 price probably does come somewhere closer to some sense of fair market value. And while I do appreciate from a deal-making perspective Benjie's suggestion or wish that they had held their line, I think one of the complicating factors is that, again, without knowing anything specific or any non-public information, it seems that Fanatics' plans and rollout have not been going quite as smoothly as they had hoped. They initially said they would be live in every state by NFL season of this year. They were acquiring the Amelco source code that they were going to repurpose for their own needs. Then they were trying to buy, bet parks, now looking to PointsBet. And so, without knowing truly what's going on the inside, I only wonder how desperate might Fanatics have been to make sure to get the PointsBet deal done if they want any hopes of going live according to the go-to-market strategy and roadmap that they currently have. And if they did not get that deal done, what would their alternatives have been? Would they have been able to get to market in a critical number of states without a major acquisition this year? I don't know the answers to those questions, but I imagine they were weighing on the negotiation process and Fanatics' decision to increase their bid, which, again, although it was a 50% premium from the initial bid, it still is less than 1% of Fanatics' market cap. They most recently raised at a $31 billion valuation, and they have a massive, merchandise business that throws off a ton of cash. So I think all in all, if you ask me in a vacuum, does it make sense for Fanatics to pay $225 for PointsBet US, given where we currently stand? I think the answer to that question is yes.
Benjie, will Fanatics, a quick answer here, will Fanatics be one of the top 4 operators in the next 3 years, let's say?
Short answer, I'll go with no.
Interesting.
It's that is like the million or billion dollar question. I don't know. My sense is that it hinges on whether consumers truly value a one-stop shop experience where you place bets and then get money that allows you to buy free jerseys and tickets and things like that, and whether Fanatics can deliver the product experience that capitalizes on that consumer need if it is truly there. If either one of those things is not the case, if it ends up that people want to bet on sports at their sportsbook and buy jerseys from a merchandise retailer and buy tickets from a ticketing retailer, or if it ends up that people do want that all in one place, but that it's just too hard to create a product that seamlessly cross-sells you between all of those, I think it becomes difficult to see Fanatics in the top 4. If both of those things do end up being the case, then perhaps they have a shot, but it still is not guaranteed.
That was the longer answer. But here's the thing, right? Now, and guys, look, Pierre, we also said within 3 years. It's going to take them a year plus just to get their footing together as it pertains to getting it together with PointsBet and kind of integrating that asset and figuring it out in terms of where their platform fits in alongside what they're doing with the Amelco platform, internalizing the Bannock folks who are super talented, figuring out the human resource challenge of migrating some of the talented people that are already on board at Fanatics and integrating that with some of the super talented people that call PointsBet their home, and just bringing all that together and building the house. Like, that's going to be in and of itself a year to a 2 year process. So it's going to take a little bit longer, I think, for them to get to whatever their peak will be within this space. 3 years is, I think, a short time frame for
Great
that.
points.
Speaking of Challenger Brand, I want to jump over to the last point of today, which is I want to do a little bit of a deep dive on Underdog Fantasy today. Last time in the first episode, we did better with a good analysis of the company and its potential future. And today I want to talk about Underdog Fantasy. So, Jeremy Levine, the CEO and founder of Underdog Fantasy, has a really great and interesting history in American fantasy sports and also online sports betting. His company was acquired by FanDuel a couple of years ago, and he was set to become kind of the CEO of FanDuel US there for a while. It didn't play out, and instead Jeremy then founded Underdog Fantasy, which has become one of the main players on the fantasy sports scene today. Now, Jeremy and Underdog have communicated that they are eventually flipping the switch and launching online sports betting as well. I'm really curious how this will play out. Now, again, it's proving to become very challenging to stick around in the online sports betting place in North America as an operator. And Benjie, let's start with you for this one again. Do you feel that Underdog has a good opportunity to succeed in this really difficult space? And what, in that case, would make them different, let's say, than the other players?
Well, the first thing is we haven't, to my knowledge, we haven't seen this playbook before. And what I mean by this playbook before is taking a fantasy asset that's built up a credible fantasy product with a significant following and a meaningful user base, and taking that group and then converting it to sportsbook. I guess you can say that we've seen it as it pertains to like the FanDuels and DraftKings when they kind of got going. But to the acquisition of the GOAT platform and bringing it in and to kind of marry the two together, because I think what Jeremy's looking to do is to create kind of an all-encompassing kind of all-in-one company where the sportsbook and fantasy experience live kind of within one household, so to speak. And look, the state by state licensing piece, and we're not even live yet with sportsbook yet on the Underdog side, so it kind of remains to be seen how it will play out. As it pertains to the product side, one of the things that Jeremy and his team have said is that even from a sportsbook standpoint, they want to create some product differentiation. We haven't really seen much from them as it pertains to what that differentiation will be. I think they're keeping a lot of their cards close to the vest. They're not really stating when they'll be live with sportsbook, to my knowledge, and they're not really indicating what the true product differentiators will be. So I think there's a lot to uncover here that will be uncovered as we see it unfold in real time in the months and years ahead.
Yeah, I think those are all great points. I don't know if there is anyone who will successfully crack the top 3, top 4, top 5 in market share, whatever you want to call it in this space. And there's really only a handful of challenger brands that have any chance at all. And some of them include multi-billion-dollar companies like Fanatics and Stake. But as far as, venture-backed startups go, Underdog is certainly on my very short list of companies that have a chance to disrupt the incumbents, if it is even possible to do so. It may just be that without the economies of scale of an MGM, FanDuel, or DraftKings, it is impossible to gain share. But we will see what Better and Underdog in particular, try to do in that regard. Jeremy, probably above all else, is a product guy with a really keen eye and almost religious focus on really intuitive, easy to use products that delight consumers and that bring something different to the table. That's what they did when they really popularized Best Ball, which is their fantasy product that they brought to market several years ago. And to Benjie's point, although we don't know any specifics, it seems Jeremy has some similar product differentiation tricks up his sleeve as relates to offering a different twist on the conventional sports betting experience. The other thing that I have come to really, really deeply respect about Jeremy is his ability to know what his strengths, know areas where he is not as strong, and hire the right people to solve all the problems around him. And if you ever ask Jeremy, and he's been asked this and answered in the way I will mimic here on stage many times, if you ever ask him, how do you decide what everyone at your company is going to do every day? What he says is, I don't. I hire people much smarter than me for all the things we need to get done, and they tell me what they're going to do and what the 5 or 10 people who are reporting to them are going to do every day. And that's an outlook and a philosophy that I think is the right one and that I have great respect for in a founder. what I have even more respect for is the ability to actually go out and execute and hire the caliber of people that Jeremy has succeeded in bringing on. And so, again, it is not at all a foregone conclusion that anyone will chip away meaningfully at the market share of the market leaders. But you combine Jeremy's history as an entrepreneur, his ability to raise capital, his incredible eye for product, and ability to hire top tier people in all of the areas where the company needs to grow. He definitely should be on everyone's short list as a potential, serious disruptor in the space and someone who can roll out some products that might really change the landscape.
And I'll add to that, Lloyd. You talk about Jerry being a product guy, no question about it, and his eye for talent and hiring people that have the qualifications. And he's fantastic as it pertains to building out his team, and he's got some great people on board. No, absolutely no doubt about that. The one thing that Jeremy often says is that, and I agree with him, is that the U.S. kind of sportsbook offerings that we see today generally all mirror one another, and generally all come from the European vein, meaning in many instances, the technology that is backing these products, the platforms were founded in Europe and built for a product that was geared to that part of the world and to a previous time frame in many instances. And that what he wants to do is kind of introduce a product that's more US specific, that's geared more to the stop-start nature of American sports. Again, we haven't seen the evidence yet on the sportsbook side of what all these products will look like, but there's no denying the success of best ball. And then to your point earlier in our previous podcast, Lloyd, we talked about Joey Levine being a great entrepreneur and somebody that you wouldn't want to bet against. I can tell you that Jeremy Levine is a fantastic entrepreneur, not just within the sports betting space, but has his tequila brand as well, and with some pretty good high-profile partners that are involved in that. Fantastic when it comes to raising capital, great at hiring. Definitely not somebody I would want to be betting against as well in this front.
Yeah, that's my perception as well. Jeremy again comes across as a leader that you want to work for, right? Like kind of like this gravitational field that pulls in this kind of talent, which is really difficult when you build a business and you're up against the DraftKings and FanDuels who are much stronger financed than what you are. It's like how do you get that talent to come to you rather than to the incumbents essentially? And to your point, Benjie, that is something I took note of as well, that Jeremy has communicated that kind of like the American kind of mindset in sports betting is much more player and statistic centric rather than the European traditional sports betting player is much more team centric. And he talks about this as being like a key differentiator in how Americans like to how they like to operate a sports betting product. But it sounds to me a little bit almost like Joey Levy is better. It sounds almost like he talks about Jeremy Levine also talks about instant gratification. So it almost sounds like it's like a micro betting type-esque product that he is looking to build here. I don't know what you think about that, Lloyd.
My thoughts are just that while, especially now, it does seem better and Underdog are something of competitors or future competitors, Jeremy and Joey have been friends for a long time and spend quite a bit of time together. And undoubtedly have rubbed off on one another in terms of their philosophies on the outset on the way the market is developing. And I think unquestionably, instant gratification, minimization of decision fatigue are some of the most common topics across all consumer tech right now. And it makes sense that two of the younger, ambitious challenger brands in the U.S. sports betting space would be trying to bring to the space features that we have seen evolve in the remainder of the consumer tech ecosystem, but not yet seen, gain a stronghold here. So I don't know how close or far the products will end up being together, but I certainly think Jeremy and Joey probably have had some influence on each other, and it would not at all surprise me if both of them have come to similar conclusions, even completely separately and in the absence of any collaboration.
Lloyd, I thought you were going to go out on a limb there and predict that the companies merge in 2026 or something. Yeah, I mean, there are some similarities in the viewpoint, but I think where the biggest similarity is that they both view the current sports spec experience as it's fantastic for what it is, but I think they both view it that there's another demographic out there that maybe isn't being as targeted in as meaningful a way as it could be by the current experience, and they're building something that might be tailored more to a combination of an emerging generation and the more casual sports better than what the current sportsbook experience provides. So I think that the mindset is similar, but the way in which they're going about it is different. But there are some similarities for sure.
Final question for you here today, Benjie. Who do you think would win in a hypothetical scenario where Fanatics enter the market and the Better and Underdog Fantasy join forces in the Super Challenger here?
So you're asking me
very hypothetical
versus
question.
The hypothetical question of Fanatics versus a combination of the two companies?
Yes, that's it. That's my final question for you. It's a very difficult one, but essentially what I'm asking, Benjie, is two extremely talented founders, or essentially talent that are entering the market hyper aggressively. Two young founders that are trying to build something incredible versus a company that has much more legacy, but also has a much stronger balance sheet and so on.
So look, first of all, I think there's room for all of these people to succeed, right? Whether it be all of them independently or if the other two were to hypothetically combine, I think there's room for success for all these guys. It's a big market, a big space. It's going to continue to grow as more states open up. And, to the point of Underdog, they also have the fantasy angle within it. And, I think that if you look longer term, there may potentially be some legislation that benefits them in that capacity also, right? But I do think that, when you look at the current incumbents, there's going to be some sort of a brand, whether it's a Better, whether it's an Underdog, whether it's a Fanatics, whether it's the 15-year-old sitting in his basement who comes up with something different from all of the above, that will penetrate the marketplace in a meaningful way by attracting an emerging demographic that sees things in a different way. So I think they all have the right idea. It's just a question of which one will be more successful. But I do think that what Better and what Underdog are doing is the right approach for a venture-backed challenging brand.
I thought you were going to ask who would we bet on if there's a fight between Elon Musk and Mark Zuckerberg. And even though Elon weighs a lot more, I've seen some books put up like Zuckerberg minus 160. And I think those odds make about sense to me. I would probably bet on Zuck at minus 150 to outlast Elon Musk in some sort of physical MMA cage match or hand-to-hand combat. But alas, that is not actually the question you asked. So, there you go.
But what about Michael Rubin versus Jason Robbins?
More juicy details on that once we stop the recording here.
Yeah. In a hypothetical MMA fight, I'm talking about here. But yeah. Anyway,
no comment.
No comment, guys. Thank you so much for the second episode here of Vested Interest. It's been great as per usual. I'm going to join my friends here behind me, who is currently doing a barbecue, and enjoy the rest of the evening here. But great to see you both. Have a good rest of the day over there, and we'll see you next month. Thank you so much.
Thanks for having us.
Bye, guys.